The KRE regional bank ETF dropping more than 12% today, touching its lowest level since November 2020. First Republic, Western Alliance, Metropolitan Bank among the biggest laggards. First Republic closing down 61%. Could some of these beaten down names actually be worthwhile buys at this point? Let's bring in Christopher Marinac, Director of Research at Janney Montgomery Scott. Chris, great to have you with us.
Thank you.
That was sort of my first reaction. I mean, the federal government came to the rescue. And plug the hole. And so is it time to be looking around for some bargains? Are we going to look back on this day and think, if you had a steel stomach, this was the time to get into some of them?
Yes, I absolutely agree. I agree with you. I think when you go back to March of 2020, even September 2020, and even in the fall and spring of 2008 and 2009, those were moments to buy banks really on the cheap. And there's a lot of great companies and good management teams that you can acquire at a big discount. And, we advocate taking a flush of tangible book value, including all of the held to maturity securities losses that are unrealized and going forward. I think the market's in the process of doing that. And I think there are a lot of great buys, even the names that were the weakest today. There's a lot of survivors there and ones that can thrive as you look at the next 6 months.
Maybe I'm asking you to reveal your secret sauce as a bank analyst, Chris, but what specific items are you looking at to determine whether or not these survivors are worth a gamble at this point? I mean, there are certain things that we've not ever really talked, like non-insured deposits, held to maturity. I mean, these are things that we don't really talk about. I'm sure you talk about it all the time, but what are you looking for specifically?
So you start with tangible book value, and then you have to make adjustments for the unrealized losses that are in securities portfolios. So the available for sale losses are already included in what we call the AOCI. But then the held to maturity losses, which really was the wrinkle that particularly was problematic for Silicon Valley, that can be wiped out pretty easily. It's just an accounting entry, and you take the after-tax effect per share, and that's what we like to do. So when you do that, a lot of names are still inexpensive here, particularly after today's correction, not to mention the past 2 days from Thursday and Friday. So the cumulative impact has really led to some excellent buys after today's activity.
Before we get to the specific names, Chris, I'm wondering, they may seem like buys in the operating environment that exists currently, but what are some of the changes to the operating environment that you will anticipate that could actually be, make it harder for these banks to make money?
So we think the access to capital will be constrained. There won't be capital raises for a while. That should be pretty obvious. I think most banks will be profitable in the first quarter. I think reserve building will continue, but the basic spread business is still intact. I think a lot of folks focus on the cost of funds going higher, which is true, but we also have a loan portfolio reset that continues to happen as you drag on higher interest rates from last year and the ongoing Fed tightening. That's going to be positive for spreads on the standpoint of loan yields and earning asset yields. We're just going to have less of that because loans will most likely fall, earning assets will constrict. The deposit outflows of the past week will constrain some of that from a dollar perspective. But we think overall credit quality is still excellent in the bank space. And the basic model of banks making money and being able to pay cash dividends is still very strong. I think it's been a lot of confusion, a lot of misinformation the past couple of days, and eventually the storm will calm and the seas will part such that banks can go back to trading at book value and higher as we go forward. Again, credit quality is really good, and we have much lower risk in the system than folks understand from a pure credit perspective. I think we have definitely slipped on a banana peel as it pertains to this deposit worry and scare. And I think that the movement to the too big to fail banks will not last forever. The main lending in America is still mid-size and small community banks, and I think those companies are excellent plays. A lot of them are dirt cheap based on the last few days of trading.
Chris, it's Karen. Let me ask something about the loan to deposit ratio. What did you used to think was a good loan to deposit ratio, and has that changed as we think about maybe deposits aren't as sticky as we thought they were?
Sure. So in the old days, you used to look at 95 to 100% loan to deposit ratios, and now we're much more in the 85 to 90. The challenge that we see is that deposits were falling about 4 or 5% in the system, and clearly that accelerated in the past couple of days. But at the end of the day, as things normalize at the end of the month and into next year, I think being at that 95% range is fair. I also think that you will see some contraction of loans as we go forward. Most banks are going to be very careful with their lending at this juncture, and I think that credit will be more constrained as a result of the last few days events. That's unfortunate, but I think that's what will play out on balance sheets. I don't see any extreme jumps. We have a lot of liquidity in the system. The challenge is, I think we had a fear of confidence and a misunderstanding on these deposit runs, and to some extent it was the company's own doing, the way they were positioned.
So I do want to get to names, Chris, because everybody wants to know what you would recommend. I want to put back up the chart that we just showed. There was a lot of information on that chart in terms of reading all the dots and reading what it means. Lower risk deposit base, JP Morgan would fall into that category. A higher risk deposit base, obviously SIVB fell into that. But on this sort of like dot plot chart, Chris, what do you like here? And kind of walk us through why you like it.
So we think that there will be plenty of survivors on this list. I think most of them should be surviving. Looking at all the names, I particularly like Fifth Third, ticker FITB. I know Tim Spence was on early this morning. I think he has an excellent handle on interest rate risk and also on credit. They're a very innovative company in the fintech arena, which still has merit as we go forward. And I think they're also very flexible with concentrations, and I think that shows in their consistency of earnings over time. Truist, certainly on the chart that you shared, is a company that did a very unique capital move in the last few weeks to sell a portion of their insurance unit that was adding 30 basis points to capital. That's going to help them pass the stress test in June. So that company certainly is not only a survivor, but a thriver. And I think that many of these regional banks that you have here have definitely a lot of good things going for them. And I think as you move down the food chain to even more mid-cap names, there's a whole list of names that are inexpensive as well. They're positioned very well because credit quality is not the issue today. It's much more these perceived access to liquidity. And we think liquidity is still really good. It was just the speed at which the friendly fire unfolded at Silicon Valley was just too quick to handle and too much to handle. And of course, it spread, as we all know, to Signature.
Slip on a banana peel really sticks out to me because that really implies it's sort of like, just a minor fall, it's a scrape or something, you hurt your knee, your bottom. I have to ask you, did you cover Silicon Valley Bank shares and what was your rating on it?
So my colleague Tim Coffey had it rated neutral last week, so that was not an issue for us. I think what transpired was just a very quick recognition that the company needed to position and raise capital. Whether they were told that by the regulators or whether they were getting ahead of the rating agencies, I'm not sure we'll ever know. But it unfolded very quickly. And I think the investment community just didn't buy their explanation. And I think that was one of the problems last Wednesday and Thursday that led to the demise of the company.
Chris, thanks. Great to have you with us. Chris Marinac. See you soon.
Thanks. Have a great night.
Bonawyn, would you be inclined to take a flyer?
Yeah, I like Key and I like Fifth Third. Fifth Third is kind of like a super regional. I don't think it has the same, well, none of them have the risk of contagion. I mean, this is overblown, but I don't think from an operational standpoint it has that risk. And then Key Bank, which is very large in the real estate lending, you have hard assets that are marked to a certain loan to value. I think it's something that's tangible. I think those two banks kind of stick out to me in terms of being operationally intact.